Good morning. Thanks very much for coming. I'm Jim Sterling of UBS, and it's with the greatest pleasure we welcome one of Chicago's most successful entrepreneurs to his first virtual appearance before the CFA Society of Chicago. As founder and chief executive officer of Wintrust, he has built one of the fastest growing and consistently profitable financial services companies in the history of Illinois. Known for his ability to attract and retain outstanding executives, he has made Wintrust one of Chicago's leading corporate citizens, devoting thousands of hours and millions of dollars to the communities that Wintrust serves. He is a graduate of Georgetown University and a certified public accountant. Together with his wife, he's become a leading philanthropist, serving on boards of Northwest Memorial Hospital and a number of other outstanding not-for-profit organizations. With suitable virtual applause, please welcome Ed Wehmer.
Thank you very much, Jim. A great introduction, and we're very happy and excited to have Ed with us here today. Thank you for joining us at the Distinguished Speaker Series, Ed.
Thanks, Nick. I'm looking forward to spreading some propaganda and some wisdom.
Fantastic. So obviously today's the day after Election Day. Probably many of us didn't get quite as much sleep as we normally did. I think expectations going into today were probably for a blue sweep. Looks like that hasn't happened. The lean now is toward probably a Biden presidency and Senate control maintaining with the Republicans. What are your early thoughts on implications of this for your business?
Well, at least we got some balance. If you had told me yesterday we could keep the Senate and defeat the fair tax or the tax amendment in Illinois, I would have taken that all day. The problem with it is they don't play well together, and we're going to have 4 years of more bickering and they'll probably investigate this and that. They'll get on to the business of running the country. It's something has to change down the road. People have to be more tolerant and listen, and we gotta compromise to get things done, because this partisanship has to end. It's become so vitriol. It's just awful, and it's got to end if we're going to move forward. And it just takes everybody to sit down and listen a little bit and compromise a bit. And if we get that done, it'll be fine. But the bigger issue will be by keeping the Senate, the regulations and increased taxes are going to be harder to get through. The regulations that if Elizabeth Warren were to become Secretary of the Treasury, holy crap! But that's gonna be there because they can make they'll put in their own regulators, and it's going to be kind of tough. But for some reason, I don't like banks, and I don't know why, because we just stepped up and helped them with their PPP program. They couldn't have done it without us. They certainly would have been lost without us.
Right. And interesting. I mean, historically, where you had that split presidency and Senate, those are historically good times for the market, because there was a spirit of compromise and moderate policies went into place that everyone could get behind. So hopefully we do come back to that, because that's certainly what the country needs. The point on the PPP loans is a good segue to the next question. It's likely that we do have a next round of stimulus once this all is said and done. I know Wintrust processed over 12,000 PPP loans during the first round of the program. What are you anticipating with the next round of stimulus?
Well, our staff really stood on its head to get that done. We put up a system in 7 days from scratch that actually opened up the night of that the PPP process opened up. Many of the big banks couldn't do that. I was scared, a lot, because I'm going, things, we're not that good. Sure enough, we had to shut it down in 45 minutes. We had 3,000 applications in fully, and it ran like a top, and couldn't be proud of our team to put that together. But now we're in the forgiveness process, which is taken forever long. Hopefully they can get to the point where they can have the loans under 150,000 just automatically forgiven. I think that makes a lot of sense, because Otherwise, the 3 billion we have on our books will be there forever. But I
Sure.
believe the second round will come through. It will have more strings attached. It won't be, the first round was good because it was simple. I've always said that the U.S. government is not your best counterparty.
Right.
You go back to TARP when they put it out, then they came and changed the rules when the Democrats came in. Hopefully there's none of that shenanigans going on, but I think there'll be another round. It'll be more restrictive, but I think that we can, if we did 3 billion last time, we'll do 1 billion of that this time. And I think the need is there, but it's interesting if you look at the loan modifications, because the regulators laid off us on loan modifications, either giving up principal or interest for a 3-month period. You've got 2, 3 really free extensions before you hit the TDR, the troubled debt restructuring categories. And our numbers were like 7%, and the industry was about 10 to 12. We came down to 1.4%. So I think it's just that 1.4%, mostly restaurants and hard hit industries that need the help. So I think about $1 billion. I think it'll be worth about a third of what it was from that regard in terms of new PPP loans, whatever they want to call it this time around. I think stimulus checks will come out again, and I think everybody will get another $1,200 and probably get the extra money in the unemployment benefits. So I think that that'll happen relatively quickly after the elections are decided.
Right. Okay. No, that's great. And certainly, standing up that process so quickly was a huge lift, I'm sure, for many of the small businesses that bank with Wintrust.
Oh yeah, it was great. We picked up probably 1,000 new customers who had been at other banks, who many middle market customers, lots of small, not-for-profit, minority area businesses that we reached out to because we had the capacity to do it because it was running so smoothly. We probably picked up 500 or 600 new prospects along the way. They're moving all their banking to us because of we call the halo effect. We had another 300 to 400 these small not-for-profits. We reached out to help them get through the process. So we tried to be even-handed across the board when we did it, and it's paying dividends for us in the long term because I think people realize you don't really need to know your banker until you have a problem like that.
Sure.
I got so many questions. I didn't even know who to call it, B of A or Chase or Harris, just to ask how to do it. And we were all over. We were asking people. We would call up and walk them through it. And knowing your banker was a big deal. And I think that's really helped us. We've grown $10 billion in the last year alone, even before PPP. And that's all organic growth. So we're about $44 billion now, which makes us probably in the top 50 banks in the country. It was a heck of a run, I'll tell you. But I think people are realizing that the high touch, high tech approach we take is a really good way to bank.
Well, as you said, like you said, you need the banker when you don't need a banker until you really need it. I think obviously the way this played out, this is really supports the notion and the value of having that community bank with the local touch, the local representation. So certainly,
I think ours is the model for community banks going forward. I mean, smaller banks just can't survive, not just because of the competitive and the money you got to spend on technology. It's the ability to generate assets to cover. Sure. And I think our model of the community bank approach on the retail side and the overall, we sub-brand all the community banks with a Wintrust community bank, but the commercial banking is all Wintrust commercial banking, Wintrust asset-based lending, so it's worked very well. We've got the size and the bulk to handle it and the sophistication to handle pretty much any deal. At the same time, keeping that local touch at the retail level, it's a little bit of a balancing act, but if people get it, it works really well.
Sure. No, great. We've seen 10-year yields come down a little bit today. I think it pulled back maybe from some reflationary expectations. But broadly speaking, obviously interest rates, net interest margin is a key component of your business. What are your thoughts in terms of our current low interest rate market, and how do you see that, playing out in the years ahead?
Well, I think that they're going to be low for a period of time. That's for sure. The government cannot afford to let rates go up because, the trillions of dollars of debt that they've added. It's not good right now. I could control both sides of the interest, the long end and the short end. I can make a lot of money too. They turn over $100 billion in the Treasury every year from the Fed.
Mm-hmm.
That was before the latest round of QE. I think if we did what the Fed did, we'd have a cease and desist in a day. They're borrowing short, lending long, and they're growing like a weed.
Right.
And that can't be. That's not allowed to. If we're a bank trying to do that, it'd be over us like flies on what.
Sure.
But for our perspective, the only thing you can do is really just grow through it. You're going to be working at we're about 260 margin now, probably can get up to 275 because we got so much liquidity right now at 10 basis points you're making on it.
Sure.
We try to shrink because we added a bunch of liquidity to the bank the end of the first quarter when COVID was just hitting because we saw everybody's drawing on their lines of credit. Usually they're about 50% drawn. They got up to almost 60. So we didn't know they'd have a special for the PPP loan. So special funding by the Fed. So we put $3 billion of institutional funding on the books. Let $1 billion run off last quarter. It was made up by $1.2 billion of new core deposits, cheaper. We let $600 million go this quarter. We're already made up with core deposits. So we're going to take it, and it's going to hurt our margin for a little while. But if we can grow without the commensurate increase in expenses and maintain a positive interest rate sensitive position, we don't lock in this crappy margin, we'll be fine.
Yeah,
that's our plan right now. So we've got $3 billion of PPP loans we're paying off over the next 2 quarters. We have to make that up, but plus the mortgage business been very good for us. So the low rate environment, having a mortgage business is a nice internal hedge for us.
Sure. So maybe a quick follow up on the Fed's action. Is there a danger they're going too far with their interventions and really preventing the market from performing its function? I.e., kind of keeping zombie type companies afloat because there is so much liquidity around.
I don't know about the dead companies afloat. I think you die. They put all the stimulus in the world in there, but if you're not gonna, if your business doesn't work, it doesn't work, and I don't think it's doing that. But sure, there is the issue of inflation.
Mm-hmm.
I mean, if you look at the money supply numbers, they're as high as they've been since World War II, end of World War II, as is the deficit as a percent of GDP. And we can handle that right now, but if you add another $3 trillion worth of stimulus and additional buying, it's artificially low, too much money chasing too few goods and services.
Sure.
You're going to have inflation. And to me, it feels like the 70s. Not going to happen overnight. Eventually, it's got to catch up with you, though. I mean, certain laws that don't change, basic financial principles and economic principles don't change. But too much money out there chasing too few goods and services leads to inflation.
Sure. And it does seem like there's complacency out there today because I think there's a lot of expectation that would happen after 2008. It didn't really happen. I think there are obviously deflationary pressures, but certainly, but by the textbook definitions of it, you'd expect at some point that inflation does come back.
You think so?
Mm-hmm.
What do I know, though? I mean, I think if you're an investor, you got to have you have to have some fixed income. You have to have some equities. I think you have to have some hard assets too. I think I told you we were talking earlier. I just bought another farm.
Yeah.
I mean, the yield. The first one I bought was yielding like 5.5%. This one yields 4%.
Okay.
Not bad. You don't do anything. My kids all go, "When are we going to go to the farm, Dad?" I go, "Never." Lease it out.
Is the farm in Illinois or Wisconsin?
One's in Iowa, one's in Indiana.
Okay.
But I mean, it's buying some hard assets is not a bad idea right now. If you just balancing it out, if you think inflation is going to happen, and important to keep it a balanced portfolio, I guess.
Yep, absolutely. So now I'll pivot a little bit towards, obviously the role Wintrust is playing in our kind of current COVID challenge time. Obviously, you have a really integral role, as that local community bank, working with entrepreneurs and business owners. And obviously in the current environment, small businesses, perhaps have never had so much pain. How does, Wintrust, how's Wintrust kind of handling this current environment in terms of loan performance and working with these small business owners?
Surprisingly, you wouldn't think there was a pandemic going on if you looked at our numbers, our delinquency numbers, our non-accrual numbers. They just, we have this CECL rule now. Throw that out, which may talk about that in a second. But you just look at non-performing assets, non-performing loans, and they are as low as they've been as a percentage. They went down this quarter.
Wow.
They're as low as they've really ever been, and so that you would think wouldn't be that good. We also, I talked earlier about the number of deferrals that took place. Those are down to basically nothing again. We have about $1 billion in franchise lending, of which 85% are QSRs, quick service restaurants. Like I said, we look up at the menu, not down at the menu. Those are doing it about 100. They're performing about 105 to 110% of where they do it normally. McDonald's of the world and the like,
Sure,
doing extremely well. Commercial real estate is doing okay. You gotta worry about that only because we never were really into hospitality. Then we've got a couple of hotel deals, but all with great backers behind them. I don't worry about them. The ability to withstand this. I lost my train of thought there. Sorry.
but just with with the loan performance. So that is interesting. You're saying low, non-performing loans. In terms of the loan deferrals, Ed, I think you previously said if they ask for it, speaking of your clients, they get it. Often tacking on the payments to the end of the loan. And I guess that's certainly a credit to those relationships you have with those clients that those kind of conversations can occur.
Yeah, we took kind of a share the pain approach. We weren't handing them out like lottery, like candy.
Sure, right.
We said you got to help, but we had to make an evaluation of the long-term future of the enterprise itself and the ability of the owners and what have you to step up and do what they could. We weren't just going to kick the can down the road. So I think we enhanced our credit every chance we got, which is a good thing, and shared the pain. And we're not. The guy gives you what he can, without strangling him. That's fine. But we're your banking partner. When we make our loans, we don't change our loan policy or our pricing parameters for anything. So I always tell people, if you want the best deal, you may not get it from us. We're not going to be the most aggressive. We're going to leave some room to help you when things get bad, because it will get bad. You start with your legs up against the wall, you got nowhere to go, right? So we've always been conservative in our lending. We've operated a third to half of what our peer group does in terms of non-performance and charge-offs in every cycle. Because of that, because we're able to leave some dry powder to work with our customers, and that's an important thing to do.
Sure.
So yeah, we have the relationship with them. We work with them, and knock on wood, so far so good. I'm not naive enough to think that we're not going to get banged up a little bit, but in the last year, we've taken almost $200 million, well over $200 million of provision for loan losses. That's a lot for us because a third of our portfolio, basically our niche portfolios, don't have any losses in them at all, like zero.
Right.
So I think the median loan loss provision or reserve now is about 155 for the top 200 banks. If you look at us, and they don't have all the niche. We're very diversified in our lending. So our premium finance life insurance business, which we have about $6 billion, not good. We've never had a loss in it, not one. Our other premium finance business, about $5 billion, is we run losses of 20 to 25 basis points. So when you take those out, you have 188 on the rest of the portfolio, we're extremely well covered. So
Sure.
I think we should be in good shape going forward. The CECL though is, you say, it's based on a Moody's model. We pick Moody's baseline model, and it's all mathematically driven. And about the 48th time they've changed the loan loss provision methodology in my career, all of which are just, none of them work anyhow, but I think you should just go direct charge off and keep more capital, call it a day.
Right.
But, I think you're going to see, if the guy at Moody's has hemorrhoids that day, he thinks the world's coming to an end, your
Sure.
provision goes to the roof. And,
Right.
we have no control over it. So it's, we've taken a lot. Last quarter, we took 25 million. Well, in the last 2 quarters, we've taken $180 million in provision. Our non-performance have gone down. Our charge-offs for that period were probably 20 million bucks.
Wow.
So we're
that's impressive.
doing a lot of building up on the reserve side and
Sure.
see where that goes. But
Oh, that's very interesting. And I'll say personally, my wife, and we talked about this a little bit before, my wife's fashion accessory business, Coronet Collection, banks with Wintrust, and it is because of the service and the local presence, and been very pleased with it. And so, certainly a firsthand experience in terms of how this model works.
yeah, our model is different though. People, especially analysts, don't understand our model. They think it's very cumbersome. It really isn't. It's everything that doesn't touch a customer is consolidated. So, the deposit ops, loan ops, technology, all is consolidated behind the scenes. It's really a marketing approach and a cultural approach. It also helps us differentiate our level of how we provide service in a commoditized market. I think everybody thinks, oh, you can go banking anywhere. But I think we add a difference by how we do it with our 15 charter banks and all the different brands brought together by the Wintrust sub-branding. And we grow. If you look at how we grow, we take what the market gives us. Sometimes it gives you acquisitions. Sometimes it gives you organic growth. Right now it's giving us organic growth out the yin yang.
Sure.
We're taking advantage of that right now. But if you look at our organic growth profile, we have that you look on our website and see it. We have growth through acquisition and organic. I think that we grow organically because of how we differentiate the market. I'm pretty sure that's why. The personal service. If you look at some of our competitors that are the mono brand, you can use MB, which sold before and the like. They can only grow through acquisitions. And they grow through acquisitions. You live on the accretion, then the accretion goes away. And it's like taking dope. Then you got to do another one, and then you got to do another one. Where the pain comes and hits, or you eventually sell, which MB, for a lot of reasons, was smart to end up doing, I guess. But so I think it allows us to grow nicely, and I think it's important for analysts to understand that banking is such a homogeneous business because of the way the numbers are presented. You get caught, the numbers all come out. And it's easy to screen scrape and put. Say, well, your reserve's lower than everybody else, so I don't like you. Well, is it really? Look, you have to learn you have to ask questions. And what we're seeing with younger analysts is that they just screen scrape and they get a little lazy, and they don't get to know the management team. They don't get to understand the philosophy as much as they should. I think they're missing out on some opportunities by just screen scraping, as I like to say, and going from there.
Yeah, the relationship building. I think it's a good lesson for many of the perhaps younger CFAs on the call. That that's certainly a key part of analysis and understanding the full picture of any business.
Yep.
So I'd like to actually follow up on one of your comments there in terms of it being a fertile environment for kind of organic growth. Why is that the case? Is that because some smaller banks are being acquired by others, and that's leaving a hole in the market? Or can you just talk a little bit more about that?
Well, 2 things. One is with, really, it's all about credit. You really don't know where your target's credit is going to be. We've concentrated on buying banks under $1 billion, just and tucking them in and staying in the Chicago, Milwaukee area, 2 hours from really where I'm sitting right here now in Rosemont. And we basically, we bought more failed banks than everybody in the country. After the 08-09 deal, we went into what I call rope-a-dope and sat it out, hit the pedal to the metal fourth quarter 08, bought more failed banks and found more dislocated assets, had record years during that downturn. And that continued for a while. And now you're not seeing the acquisitions happening because one, there's fewer small banks. Second, our stocks have all been whacked pretty hard. But I mean, I think you're trading at tangible book value, you're at the median, which
Right.
is kind of crazy when you think about it. And so you really don't have a lot of currency to spend. So I think that now is the time that we're getting the organic growth, and it's easy to flip the switch to buying, but having certainty into the credit portfolio of the target is very important. It's hard to get that right now because who the heck knows?
Sure.
You got enough trouble worrying about your own situation. I will say, I think you're going to see, because some banks, if they can't get the acquisition, they can't buy smaller banks, they can't grow organically. They understand that they've got to be able to grow through this to get any sort of return for their shareholders with the low rate environment. You're going to see over the next year and a half a lot of MOEs coming down.
Okay.
You know, the mid-sized banks, like the 10 to 40, $50 billion banks coming together, taking a lot of costs out and really doing it that way. I think that's what I'm expecting to see, and just market deals, not a lot of premium in the deal, just
Right.
market is go. Unless there's a size differential, then you're going to have a bigger 10 to 15% premium in the market, and that's the way it's going to go. But right now, there's just not a lot going on. If there is, you really don't want to get involved because it's hard. You better buying your stock back right
So
now.
how to know what's under the?
Yeah.
How do you know what's under the?
Unless the book value. We rate ourselves the way our KPIs really are earnings growth, asset growth, and tangible book value growth.
Okay.
Because you want earnings growth, you want to get that through good solid asset growth, but you don't want to get it through acquisitions that dilute the crap out of you. It doesn't make sense to me. Never has. The guys that will buy in, they'll pick up 30 cents a share, so they'll give up $3 a share in tangible book value.
Right.
It takes a long time to pay that back. You work so hard to get it. Why are you giving it out the door? But that's all they can do. And so I think that you've got to. That's why we look at our tangible book value growth, our earnings growth, our asset growth. Have outperformed our peer group over the last 10 years by 40 to 50%, which are good numbers.
Absolutely.
Means we're growing without giving it away out the back door.
So Ed, it sounds like then happy to continue with that organic growth as it continues to present itself. You'd be opportunistic, perhaps, for some kind of bolt-on acquisitions. Maybe as we get a year or two into all this, or if we start to recover, would you consider expanding to other Midwestern markets? If you feel there's similarities to the Chicago-Milwaukee dynamic?
Yeah, I think we would. I think that we still have 180 locations in the Chicago-Milwaukee area. We need to get about a little over 200, I think, to really cover the entire area. Once we can do that, we are looking at prospects of. We're not in Northwest Indiana, which is someplace we'd really want to get to. South Bend over is about 2 hours from here. That would count. But probably nobody will sell over there, but that's been the case for a long time. I remember I've been wanting to get over there for about 10 years, and we went to an analyst at a dinner, or a investment banker at a dinner. Sat me next to the two best prospects to be. They both moved their seats. They're like, I'm not going to eat
really?
I don't smell. I'm fine. They want to sit with me. But so we're going to get there eventually, either by acquisition or by just open up, and I'll just maybe buy a real small bank and build from there. But after that, I'd like to expand like a stone hit water. Just kind of go to markets we understand and know. Indiana,
Sure.
more Wisconsin, go to St. Louis and up through Des Moines and to Minneapolis. I think would be a good next step. But you can do that either through acquisition of, if you want to do an MOA, you can do that if it made sense, or just we've been very fortunate to buy a small bank and just grow off that bank.
Sure.
It's important. You need to know people in that market if they have our deal. I really don't know anybody in Minneapolis. I don't know anybody in,
Sure.
I don't know the CO, the centers of influence, the COIs in those areas. I don't know. But if we can go, we take the time and go one at a time and get involved in the community, like that's what we do. That's our approach. We can clean up. So I still think it's true. When we started Wintrust, it was all the big banks had bought all the great little local community banks. We had no delusions of grandeur for sure. So Lake Forest National Bank was sold to Northern Trust. Wilmette Bank was sold. Hinsdale Bank sold to Harris and Chase and what have you. 50% of the people still wanted that high touch banking. So we said, I know it because I was working for I ran the bank acquisition area at Ernst when I was a young kid, in public accounting. Went on, left, and worked for a couple different banks. There were all the good banks in those towns were gone. I said, great opportunity for us to move in and take that over. So quit my job and off we went.
Yeah, that's great. And you've got a neat little video on the website. It's kind of like, cartoon kind of origin story, which is neat. And, literally started with one branch, right, in Lake Forest. And I think you said on the first day you realized you didn't have a desk or a chair and you had to call your wife to bring one over, like a folding chair and folding desk.
Yeah, I had a card table and a chair and one of those phones was about this big. Only place I worked was on the fountain in Market Square, middle of town. So I had to sit on that and call around. There was basically nothing. The employee number one just showed up, and it was funny though. We opened that bank. I started the day after Labor Day in 1991. That day where my wife had to bring the card table over, etc. And we opened by December 27th, 91. Next bank where we had nothing. I mean, I had to get insurance. I had to get forms. I remember one of the guys who started with me almost killed himself trying to wire up the used teller system we bought. He kept hearing bang. He'd electrocute him, hit himself against the wall and come back. He was an investment guy. I go, well, you don't know what you're doing. He goes, I'll figure it out. It was a lot of fun, but raised $6 million, and that's all you need now. Open a bank, you had to raise like $50 million, but back then 6.6 made the cut, and off we went.
And I think a part of the origin as well is the name of Wintrust. So we talked about this a little bit as we were preparing for this. Kind of describe how you came up with that name.
Well, we opened up 91. We opened up in Lake Forest, 93 in Hinsdale, 94 Wilmette, 95 Libertyville, 96 Barrington. All these were unit banks, individual banks that where we raised money locally and had our core group, bring equity to the table. Same time as we progressed, Lake Forest had to do 4 cap. We grew so fast, we had to keep doing. All I did was I used to weigh 120 pounds, believe it or not, but I have to have 2 breakfasts, 2 lunches, and 2 dinners. Just raising. That's all I did was out raising money. And when we hit Barrington, it was kind of ran out of friends and neighbors and family. So we merged them under one holding company, and each of the banks, the 5 banks we had a holding company. It had to be North Shore's holding company. And how we got the name was Wintrust. We had thrown a dart at a book of English companies, came up Wintrust. So and that was where we did that because we didn't anybody know where we were going until we were ready to tell them we were going. So we had Wintrust, we had Smithdown, we had all these goofy names. We're throwing the dart. When we merged everything into North Shore Bank's holding company, the original name was Wintrust. So what do you want to call it? I go, it's about Wintrust. We're never going to sell it. We're always going to be the local alternative to big banks. Don't everybody know we're a big bank, so let's just use the name Wintrust. And people go, well, what about branding, et cetera, et cetera? I go, hey guys, you make a brand by what you do, not you can call it the XYZ company. You got to walk the walk, and you got to create the culture and the brand, and that's how that works. But so then when in '08 when we went into rope-a-dope, we're about $14-15 billion. We said, boy, we got to let everybody know that we're big, but not lose the smallness. So
Sure.
that's when we started putting the Wintrust name out. You saw us aligning with different, the Cubs and doing a bunch of things we couldn't afford at the time. But the Cubs, we took the old Continental Bank building, the White Sox. Those were expensive things. So, well, go big or go home, man.
Sure.
That's
Okay,
how
so
we
that
came
kind of the sub branding really started in '08, '09, where obviously each then local branch, has that kind of Wintrust sub branding.
Yeah. And we just didn't want people to think, we're this consortium of community banks with the ability to give you everything you need to, play in the middle market and the international markets. And I'll put our treasury stuff up against anybody.
Sure.
When we did that when we came out of it, we decided to do it. We were able to get John McKinnon out of retirement. Older guys will know that the middle market in Chicago was run by Norm Bobbins and John McKinnon. Each had 45% of the market. Each year they exchange 2 customers and lose money on the deal. So
right.
John retired. Norm went on to be private bank and from LaSalle to private bank. And Norm was one of the best. I wouldn't be in business if it wasn't for Norm. He gave me early on when I had the card table sitting in Lake Forest. He gave me a loan. We knew I'd have trouble paying it back, really, but he had faith, and I always remember that. But John McKinnon came and put his band back together, the Old American National Group, and gave us immediate credibility. And they came in going, thinking we were a bunch of rubes and didn't know what we were doing.
Right.
Then they say, well, you got to do it this way and that way. I go, well, just check it out, guys. And sure enough, our treasury functions are as good or better than anybody else's out there because we're able to build it from scratch.
Sure.
And we were able to keep the costs down because I always remember when my old clients and the banks I worked at, you'd get to budget time, you need an extra $1 million. So add a penny here, a penny there in treasury. And what's a penny? It all adds up. But so we didn't need that. We could come in and undercut, still make great margins.
Sure.
And so it kept just our motto is Sam Better Products, Sam Better Delivery Systems, and kill them with service. Stuck with them. And after about a month, they go, this is really neat the way you've done this. So they all bought in hook, line, and sinker, and they're off and running. So.
Okay. Well, I'd like to follow up on the marketing because certainly the marketing push, high profile to many people on this call who live in and around Chicago. And, obviously it was a conscious decision on your part. Can you talk about, how well that's gone or any learnings just from that experience of really increasing your visibility?
Well, it's all about, you can increase your visibility, but you got to really deliver on that. And we do that by getting, our model gets you involved in the communities. And we open up in Pilsen, we open up in Winnetka. Doesn't matter. People that are from that area, they know people that get involved in the communities. So I think that reputation now is out there. And that helps the marketing too. But to identify yourself as Chicago's bank, you had to align yourselves with the iconic brands in Chicago. The Cubs, the White Sox. We advertise around the Bears because it's just so expensive. Let them, maybe if they had a local bank and they is their sponsor, instead of a Pittsburgh-based bank, they'd do better. But
right. Maybe they give them a better quarterback.
Yeah, maybe. So we advertise around the Bear games, TV and radio. And the United Center is a tough one too because you go in there, it looks like a NASCAR, and it's hard to get any sort of differentiation. So we do it around the radio and the TV. So we align ourselves with all the iconic brands in Chicago, and now the high school, DePaul, the Wintrust Arena.
Sure. Yep. That's a beautiful building by all accounts.
Yeah. Oh, it's gorgeous. We're official bank of Marquette, official bank of DePaul, official bank of Northwestern Athletics. So aligning ourselves with those has really brought us into the communities and that. And again, walking the walk and not just talking about it.
Sure.
If you look at some of our larger competitors, we supported probably, I would say, 3,500 different enterprises with financial support last year.
Hmm.
Good numbers. 15. We have 400 where people are on local boards. We want our to get involved, so get around be on different charity boards, what have you. So it's all about walking that walk. If you can do it and you really deliver, it helps. That sells the brand. The
Sure.
marketing has worked very well for us in terms of name recognition. I think the ads we run it all here from. We don't have an outside agency.
Okay.
Internally,
Interesting.
we have a group. Our marketing group acts as an outside agency. They understand our approach, our DNA. I
Mhm.
can sincerely put it out there, without a lot of hokey junk. So hopefully our TV ads are produced internally. I hope you like those, and
Hmm.
really help the name recognition. There's some other things coming down the pike that, if they happen, will align us even more with some iconic things in Chicago.
Okay.
Same in Milwaukee. So I think that it's there to be taken, and that's it adds into, talk about culture. And the best thing about opening a bank is starting a business from scratch is you get to define your own culture.
Sure.
Ours was one where I always hated bosses. So everybody hates a boss. So we hear the ground rules, we agree on a budget, go do it. You come up with better ideas. But you're the guardrails. Don't go outside the guardrails, and you get a lot of
Mhm.
entrepreneurial effect and of the individuals, and a lot of better ideas. They come and they can percolate. Plus, you get the intramural aspect of one bank versus another bank, and how come you don't want to be the last guy in the totem pole. So
Sure.
very, very helpful in that regard. And so it all fits together with the market. You got to deliver on the marketing, which I think we do a good job of being involved in the communities. But the culture that you build to begin with is what drives the whole thing.
Right. No, that makes sense. And certainly that combination of the marketing and the hosting financial education courses, community events. You talked about the local boards and local organizations sponsoring local events as well. And then that does become a bit of a virtuous cycle, I imagine.
No, it's been great.
Ed, the next thing I'd like to talk about is, we talked a little bit about, Wintrust versus the big banks. Obviously we've seen, especially now since COVID, the winners have digital capabilities, right? We're seeing that in the stock market. We're seeing that with certain businesses. And you talked about earlier in the call, high touch, high tech. How do you ensure that you are investing in those digital capabilities, the technology initiatives to help you scale, help to reach people, on their mobile devices for banking needs, that sort of thing?
Well, it's an expensive proposition. We paid already invested tens of millions of dollars in it. The interesting thing about banking is that a big bank will come out with a new product or delivery system, and somebody can mimic it, or they'll sell it themselves to recover their costs. So it's out there. It just costs money, and you got to make sure it gets all integrated and the like. So we were the first bank out there with cardless cash. We just held your card up, and Harris followed us, but we were the first ones in the market to do that. But it's a very expensive proposition.
Mm-hmm.
You have to do it. I mean, it costs a lot of dough. I think this year we'll spend over 25, 30 million bucks on it, just upgrading and keep it going. And
Sure.
but I think that, I think we put out customer surveys every year. We listen to them because they're customers and they tell you what's going on. And we've won two of the last 3 years. We won the J.D. Power Award for customer service.
Okay.
Last year we didn't get it because they said your digital isn't up to snuff. So I'm like, well, wait a minute. So we constantly review it, and we've got to obviously scale it in. We can't do everything at once, but you know, we're committed to doing it, and Sarah Better Products, Sarah Better Delivery Systems, and Gilmer Service. But very expensive proposition. But you have to be there. I think that's what's going to drive when we get out of this. I think the rest of the community banks are going to be coming, or they're going to be few and far between, because they can't spend the money to do it. Plus, as I talked about earlier, their asset generation capabilities are, we're all digging deeper on the asset side. So it's be hard for them to continue.
It certainly seems like going forward, those digital capabilities are, you know, are kind of table stakes. And, you know, if you don't have those, then it's an uphill battle, certainly.
Yep. Interestingly, since we opened back up, we had all the drive-ins open, but now we're up, I think we're probably 90% opened up in the banks, running dual shifts, and 50% in for 2 weeks, 50 hours. So we're able to, in case somebody does get it, we can, you know, quarantine, do all that stuff. But we're back to almost 75% of the teller transactions. People like coming into the banks. We build our banks as local community centers. They like coming in. So it surprised me, but it is, if you look at the number, the usage of the technology and the digital stuff, it was up probably 65%, 70%.
Okay. So obviously, yeah, those investments paid off. And so actually, you know, speaking of kind of, obviously many of us are working from home. You know, what's been the biggest challenge in the COVID environment, just in terms of, you know, running the day-to-day aspects of the business?
It's been a freaking miracle, I'll tell you. I don't know how we did it, but we're doing probably $2 to $2.5 billion of mortgages every month. Nobody's here. You come out to Rosemont, where most of these people usually are. Usually 1,600 people out here. Might be 100 people a day. Pardon me. But it's amazing how well it's working. People working from home. Now, same with the PPP loans. We had the regular business to run. We had the deferrals to deal with. We had everybody running around like crazy. Everybody working from home. And then you had to go PPP loans. We had to retrain people who were did Platinum Adventures course. Platinum Adventures is our senior program. You're not taking trips. You're not having them to play cards or having them for events. So all those people got retasked and put on it, and put on PPP loans. And I got to tell you that the spirit's been awesome. One thing you're going to miss is just the culture. Bringing young people in, they've got to learn. They got to learn through face to face, not like we're doing it here. Our culture is really what makes us different too. I mean, I try to get on and do a number of videos and chats like I do on this afternoon to get the culture across for the younger folks. But it's hard. It's really, they're missing out. It's like kids not going to school are missing out. Our people are missing out, not being with each other, but it's amazing how well we've done in terms of growing the bank, in terms of mortgages, in terms of PPP. It's a freaking miracle. If you told me we would accomplish what we did from afar, I would have said you were nuts. But it's worked really well.
Oh, that's fantastic. Yeah, you talked about that. The asset growth, you know, 10 billion just in the past year. I mean, that's amazing. Take you from the 30s to the 40s. You know, given the dynamics certainly over the past 8 months or so. Well, we're going to head to some audience Q&A here in a minute, but maybe one more question for me. In a recent article, you said, I learned what to do and not to do. One thing is, don't be too concentrated in one thing. You can't just have commercial real estate. 1/3 of our portfolio is dedicated to niche businesses. Certainly, I think that diversification has helped you. You talked about that a little bit already. Any other advice you'd give to to other folks starting off their career in banking and finance, given your experience?
Well, concentrations do kill, and by design, we had put together. If I showed you the plan we did over the beer and the cigars, we stuck to it. A good bank can lend itself up to about 75% of its capacity, which we define as 85 to 90% loan to deposits.
Mhm.
So I think liquidity is important. See some banks with 110, 120% of deposits. So you can always get liquidity. Everybody forgets Continental Bank went under wasn't because of credit, but under because of liquidity.
Okay.
The Japanese pulled the money out. Continental was at the time the largest bank failure in the country ever. And we said, well, that 2/3 is got to be differentiated between commercial real estate and consumer. The other third, you got to come from, and the core business all is relationship oriented. The other businesses are we're the largest insurance premium finance business in the country. I think between the life insurance and the P&C portfolios, we're about $9.5 billion.
Hmm.
We have the franchise portfolio about $1 billion and growing. We have a leasing portfolio we started from scratch, about $1 billion. So diversification is everything. You're all commercial real estate. As you saw in the downturn of 08, 09, you got hammered. Real estate will kill you, but you have to have, you have to have something working when something isn't. And differentiation
Sure.
helped a lot. I'd also say, you're starting in the business, you want to be a leader. And leadership is hard to find these days. And our culture I defined is put a little poem together. First part of it though is not the poem. You leave your ego at the door, number one. The smartest guy in the world, what are you doing working for me?
Right.
Second is the little poem is our culture is based on take the blame, share the fame, avoid the shame, and enjoy the game. So take the blame means be accountable.
Sure.
You're a leader. If you're a leader, you can't think of the last thing you think about is yourself. What's this mean? You think about the mission, think about the people working for you, and take the blame. Be accountable. If something happens, be accountable. Don't say he did it. He did it. You're the leader.
Sure.
You're accountable. Share the fame means push down as much of the credit as you can to everybody who really did the work. Get to the top. You stand on a lot of shoulders, and you got to make sure they're strong and happy. Or you'll fall down. Avoid the shame is you're going to see everybody's going to be faced with issues in their life where take a shortcut. And you have to wonder, is this right? Should I do this? And I always go to the 4 M's. The 4 M's are first. What would your mentor think? Everybody's got a mentor. What do you think we did there?
Mhm.
Second is what would the media think? Third is what would your mother think? And finally, the last is what would your maker think? You pass all those, you're okay.
Right. Sure.
Finally, enjoy the game is you got to have a work-life balance, which is why I really started the bank in the first place. Is my kids had 5 kids at the time and was working all day and all night. Never saw them. Like, well, heck, I could be George Bailey and open this little bank. And little we know we'd be where we are. But the kids would come through their backpacks after school, coached them all. It was great. And but you got to, life's pretty short, as you know, and you got to enjoy that game. And don't just become a workaholic. Get the right balance. And we let people, we push that very heavily here.
Oh, that's fantastic advice, as a manager. And actually, I think it ties back to Jim's introduction, talked about the executives and your reputation for employing and keeping, top-notch executives. And I think that those words that Wintrust lives by that you just talked about is a great example of that in practice. All right, so a couple questions from the audience. One is, will it be economic growth or inflation that ultimately pushes interest rates higher?
Probably, I think inflation, I think they go hand in hand, but eventually it's just gonna be classic, too much money chasing too few goods and services. Right now, I think it's gonna happen a little sooner than everybody thinks, because try buying a washing machine right now or something. There's inventories are so low right now that people are gonna be able to demand higher prices once we kind of get out of COVID and things start cranking again. I think you're gonna start seeing it happen. The government always hides. They say, well, instead of food and energy. I was going, what the hell? Food, energy, and booze and golf balls. That's all I need to live. Food, energy,
Right.
booze, and golf balls. I'm a happy guy.
Sure.
So we'll see. I think it'll be a little bit of both, but it's going to take some time because the Fed, you look at the interventions that other internet, you become a world market. You look at the interventions they've taken. I don't think we're going to see negative rates. That would be a disaster if we did. They're already way too low for. If the government was not coming in with QE, I think they'd be up 200 or 300 points. And how much more QE can the government do?
Right. So yeah, on that point of negative rates, because that's certainly a key one. I mean, I think we've seen Japan and Europe go down that route, and they just can't get out of it. And
No.
so you think the U.S. and they've said this publicly, but you think the U.S. and the Fed, no matter who runs in the future, will take those lessons to heart?
Well, as I said, well, you can't trust anything coming out of Washington, but it'll be. I think they come down with another $3 trillion package. It's going to be like, ouch, because eventually that's going to catch up with you, and you keep borrowing, and the Fed can't control rates anymore. I mean, how big can the Fed get? They've gone from what, a couple trillion to $7-8 trillion bucks.
Right.
It's huge.
Yeah.
How much more can they go? I mean, 10, 12. They're gonna have every housing bond in the country.
Right.
It's they're gonna have them for a long time because I think people aren't going to be moving as much as they used to.
Sure. Yeah. We've seen some of that already. Okay, a couple more questions. Ed, you said younger analysts tend to not take the time to understand management teams. What are some of the important things to look for?
You gotta go out to the company, meet the management team in person, and once COVID's over, and learn the history, learn the philosophy, and understand their strategy going forward. You cannot just screen scrape and think every company is the same, because they're not. If you do that, you're going to end up paying the piper. Don't listen to the whim of the week. Oh, margins are down. Well, but who can grow through them? Who can't? Rely historically on what people have done in the past, if it's the same management team. Ask if they change policies, or do they follow the herd, or are they consistent? This business hasn't changed 700 years since Medici's opened the first bank. I mean, the risks are the same: credit risk, government risk, reputational risk, fraud risk, liquidity. It's all the same. So ask how they deal with it, and but get to know the management team and thick and thin. Watch them for a little while. Don't just scrape screens and figure out the company for the next for the next quarter. You got to think long term. Short term traders just go ahead and trade short term. Don't really need to analyze anything. You just trade on the whims of the industry. But long term, you need to understand the business and how well they react over time.
Oh, good advice. Wintrust private wealth. So you anticipate any asset allocation kind of recommendation changes if there's a change in regime from Trump to Biden? No,
I think, again, this is an area where you're pretty balanced, because you can't be a market timer like that. We're in for the long term. We've got $27 billion in assets under administration through our trust company, our asset manager, and our broker dealer. But we're consistent in terms of how we deal with that. Long-term investors that meet the individual needs of the needs of the client, be it an institutional client or a individual client. Understand what their needs are, what they're looking for, fix it, and don't get skittish.
Okay. And then one more question, and thank you so much, Ed, for your time today. Obviously, is Wintrust involved in any more like kind of venture capital lending? Like how early stage do your loans go?
Wintrust Ventures is alive and well. We actually differentiate by getting into not the angel round, but maybe the second, third rounds. We also will lend, which is something the other banks don't do in this regard. We'll lend money. Bailey Moore runs this out of our 231 LaSalle office. We got into it because it was I used to have about 30, 40 million bucks I play around with. And then what's his name? The Volcker rule came in. I used to do, you know, you could just play around and make some dough. And the Volcker rule says came into you can't invest in those anymore. So off we went to got involved with ventures because it's fun, number one. Number two, it's interesting. There's serial entrepreneurs and growers as we are. It's very interesting to learn and what other people are doing. And finally, to get involved and to win over the other venture money guys to be banked with us. Those were our three objectives. So far so good. Give Bailey Moore a call at 231 if you're want any more interest, if you're interested in following up.
Great. Well, thank you so much, Ed, for joining us today, along with everyone who attended this event. If you have any questions about today's event, please contact the CFA Society Chicago office at info@cfachicago.org. If you are a CFA Society Chicago member and would like to volunteer to help plan events, please visit the Society's website and submit a volunteer registration form. Again, Ed, thank you so much. Really appreciated your time today. It was a fantastic conversation, and best of luck with the rest of the year.
Thanks, Nick. You too, and everybody out there, stay healthy and happy.
Great. Thank you.